Welcome back to Strictly Money. I'm here with Danielle Neziol, Vice President of BMO ETFs. Danielle, you were talking about a tool that BMO has that helps investors compare different ETFs. So let's take this block and walk through that. First of all, where would they find that tool? It's a BMO ETF site, is that correct?
Correct. So BMOETFs.com under our tools. We actually have 3 tools. Today we're going to talk about the comparison tool.
Okay, so let's walk through that. If someone uses that tool and we have an example where they're comparing 3 ETFs, we're going to pull up that board. So walk us through what they are seeing here and how they read this.
Sure. So what we decided to compare here are 3 emerging market ETFs all listed in Canada. So we picked ZEM, XEM, and VEE. So for an investor in this example, maybe they're thinking, I'd like to add exposure to emerging markets to my portfolio. I'd like to use an ETF. There's so many out there. So I'm going to start to compare them to understand the differences. So the first, there's a lot of things we can look at in this comparison tool, but the first thing that I wanted to highlight is looking at the ETF's objective and really understanding its strategy. So this will give an investor an indication, is it tracking an index or is it active? In this example, the 3 ETFs are all tracking an index. It's listed right there. And you can actually research more about that index if you'd like to learn more about it. Google it and go to that index provider's website. But that's kind of a first consideration to getting to know the differences between ETFs.
Okay, so yeah, objective, they always say what index they're tracking. Does it usually give any other type of information in the objective part?
The objective will say exactly what the ETF is setting out to do. So in this case, it's setting out to provide performance of emerging market equities. Sometimes the index is listed in the objective. The index is usually always listed in the strategy. And the strategy usually tells you how is this ETF going to meet its objective. So quite often that index tracking, that's the strategy in meeting the objective.
All right. So the next board we're going to bring up is the one that a lot of people pay attention to, and that's the fees, right? So let's pull that up. How should one read the fees?
Right. So I think it's a consideration for sure to know your fees. There is an MER or a management fee. So the management fee is what the fund provider charges to put that portfolio together, to rebalance it, kind of the day-to-day maintenance of the portfolio that the investor doesn't have to do. So that's what you pay in a management fee. And the MER, usually the biggest difference here is there's some tax added as well. So it's usually about 13 or 14% higher than that management fee. So when we look at MERs, definitely a consideration, but as we might see, as we dig a little deeper here, not the only consideration to make.
No, and it's not, right? Because there are some reasons why some ETFs do charge higher MERs, right? Especially like I know I've seen where if they're tracking an index or a niche market that may not be as liquid, we know that just the cost of trading is higher. Is that correct? Are there other reasons as well?
Absolutely. So for example, an emerging market index or ETF would have a higher fee because our portfolio managers are now going out and buying stocks in all the different markets in China, in Taiwan, in India, in Brazil. So that takes a little more work than if you were just to be buying the stocks in Canada for a Canadian equity ETF.
Okay.
So those are some types of things that make a management fee higher or lower than others.
Okay. We have about a minute until commercial break. So let's bring up the last one, which is the chart comparing the 3. And it looks like they're tracking pretty similar.
Right, but they're not on top of each other. So you're seeing 3 emerging market ETFs. We saw a few differences. There's different indexes. So VEE tracks a FTSE index, and then ZEM and XEM track an MSCI emerging market index. So already you're seeing those indexes are performing differently. And one of the big reasons in this case is because the FTSE index doesn't include South Korea as an emerging market. whereas the other two track MSCI or including South Korea. So that's adding some difference. And then, of course, the fee. So XEM is the higher fee. So you can see that's really
Right.
pulling back or providing a lag on its performance as well. So the fee impacting, but also that strategy impacting performance as well.